Hi, hello again, gentlemen. This is the next video about diagonal calendar spread, which, as I already mentioned, I consider to be the most profitable and amazingly also the most conservative options trading strategy. And of course, the combinations of these three merits are something which is unbeatable, as I hope to prove to you in the next videos, also in this video. Well, let's better define what exactly is diagonal calendar spread. Well, for short, by the way, we'll call it from this point on, we call it DCS, for diagonal calendar spread. That will save some of writing efforts for me. Anyway, DCS, like most of the other spreads, you sell one option and buy another one. In the DCS specific case, we sell one out of the money, OTM for short, one out of the money option, which can be call or put, for the near expiration month, and you buy one further out of the money option, again call or put respectively, for the later expiration month. So basically, you can have at the end of this spread, you end up having potentially two types of diagonal calendar spread. One is in the call side, which we call Call DCS. The other one can be in the put side, which we will call, from this point on, we call it Put DCS. Alright, and of course depends on the distance between the two strike prices in each of the positions above, whether it's a put DCS or call DCS. We said earlier that you sell one option in a certain strike price and buy another option in a further out of the money strike price, so depends on the distance between these two strike prices. You can have, the bottom line is that you have either credit spread, debit spread, or, which is something more specific, you can end up even, which will break-even spread. The very important point to emphasize is that your risk, which is automatically translated into margin requirements by your broker, is in direct proportion to the return from the spread. So the risk is higher in case of the credit, and if the credit is higher, then the risk is higher also, and lower in case of a debit. So in case of a debit, you do pay something to buy the spread, but you significantly reduce your risk. So there's a trade-off between having an immediate return on this spread and having a much higher risk. This is a very important point that we'll discuss further in the next videos. We will elaborate on that because that's actually one of the key factors in determining exactly the configuration of the diagonal calendar spread that you are about to do. Let's take one case study. The first case study is about Exxon Mobil. The symbol is XOM, and I must tell you that I've deliberately selected Exxon for this example because I want to highlight a very important point. It's very easy to locate good trades if you adopt this strategy, the diagonal calendar spread. This is something which is not very rare. The market is full of opportunities. It's not something that you need a guru to tell you how to do it. You don't need any unique screening or reporting services. It's right there in front of you, very visible, even with the largest of the blue chips. And this is why I've chosen Exxon Mobil, which is no doubt one of the largest in the blue chip sector. So let's take a look at XOM options chain for October this year and January next year. And of course there's a small question, why have I chosen this specific month, but we will address this in later videos. For the time being, let's say that we want this specific month, not something which is too soon and not something which is very much in the long term, something in the mid-term that definitely falls in this category. It's a mid-term trading. And the numbers that you're about to see is something that I've taken on May 22nd, before the market opening. So of course now the numbers for ExxonMobil are probably very much different, but it doesn't make any difference in understanding the essence of the strategy structuring process. Right, so if we take the first month, the October this year, well, allow me to draw your attention to these specific lines, the 85 and the 97.5. You can see the calls in one side, in the left side, and the puts in the right side. And specifically, please note this 85 put and 95.5 call. In the other expiration month, which is, as we mentioned, January 14, here, please note these two lines, these two strike prices, the 80 and the 100. In the 80, we mostly looking at the puts, the 80 put, and in the 100, we look at the calls. That's the 100 calls. So if we want to structure the two potential trades with these two expiration months and these specific strike prices, that brings about these two trades. The first potential trade in the put side comprises these two options. We sell one XOM October 85 put and buy one XOM January 14 80 put. And if you look at the numbers, you can see that we end up having a small debit of about 30 cents. Let's see that again. You can see here the October, the 85 is sold for about 122, and the 97.5 is sold for 131. The other months, the January, the 80 is bought for 151, and the 100 is bought for 138. Okay, so for this configuration, selling the 85 put and buying the 80 put, we are paying 30 cents approximately to buy this spread. That's for the put side. If we move to the call side, then the configuration is as follows. We are selling one of the October XOM 97.5 call, and we buy one of the January XOM 100 call, and here we pay approximately 10 cents, only 10 cents. Another important issue that I would like to draw your attention is that here, in order to get to this small debit, we need to take a 5 points difference, $5 difference between the two options, where in the next configuration, in the call side, the difference is $2.50 only, and also the debit is considerably reduced. So that's a very significant point in favor of this configuration, but this is not the only consideration. There are many more considerations, but for the time being, it looks on the surface that the call spread, the call DCS, has more appeal than the put DCS, but whether it's indeed like that or not, we'll see in one of our next videos. For the time being, let me just summarize and say that if we compare between these two configurations, we see that there are still many open questions. For example, as I mentioned earlier, why have I chosen these specific expiration months? Why not September, July, August? There are many other expiration months for XOM. Why these specific strike prices? And how do we benchmark between these two configurations, the put side and the call side? How do we calculate the potential loss, the potential profit? So there are still many open questions, but I think that already in this stage you can see the appeal in the DCS. We'll highlight that in one of the next videos, and in the next video I will elaborate on the various configurations and the various considerations that we need to take into account when we come to evaluate and to open DCS trade. So thanks at this time, and see you in the next video.